Okay, this is breaking big news that could actually affect a lot of home buyers out there and home sellers as well. And this has to do with OSFI, which is the Office of the Superintendent of Financial Institutions. They announced that they were concerned about risks associated with large and rising number of high debt with borrowers, especially those with variable or floating rate mortgages, which stands at a record proportion of outstanding mortgage loans. I'm Lorne from Dominion Lending Center's expert financial optimalfinance.ca. If you haven't subscribed to this channel, please subscribe. You're going to find lots of great information to help you navigate home ownership in this particular channel. So let's jump into it. With the economy in the danger of entering a recession, the Bank of Canada is warning against potentially more rate hikes to counter the persistent inflation, and housing market may face continued pressure in upcoming months. With that, you have compounded. Scotia Bank announces that over 20,000 potential mortgages could go into arrears or default. So you're hearing a lot of these things in the news. So combined with all this stuff, OSFI feels that they may need to make more changes above and beyond the stress tests, which are going to affect how homeowners qualify for a mortgage. So currently all mortgages are subject to a stress test. What is a stress test? Well, the stress test is basically whatever rate you're actually going to be receiving. We need to add 2% above and beyond that rate to qualify you. Okay, this is a protection measure in case rates are going to go up, which in fact they have. The question that in their mind, what OSFI, they're thinking, is this sufficient? Do they need to add added protection to protect the debt load that consumers are carrying? OSFI is particularly concerned about the rise in mortgage obligations for households with a loan-to-income ratio more than 450%. Their latest report says those with high debt are more vulnerable to a decline in income and will face more financial strain when they renew their mortgage at higher rates. This vulnerability relates to households' ability to continue servicing the debt if income declines or interest rates rise without significantly reducing their consumption, which basically means reducing your balances. This chart shows that the average share of high loan to income borrowers before the pandemic was 23.8%. The average since the pandemic onset has risen to 33.7%. So let's talk about the proposals for comment that's coming up for April the 14th. So one is loan to income and debt to income thresholds. Okay, so this is going to be at the loan level and at the lender level. Let's talk about the loan level first. When the government came up with remember their great program they thought which would help first-time home buyers get into homes, and saying, you know what? We're going to give you 5% of your down payment. You just have to come up with your 5%. That'll give you 10% down. And now you can help. Well, this will help you purchase homes. Well, that said, is the other factor in that is the other stipulations, you couldn't finance more than 4.5 times your income. Started with 4%, but then they changed it. What ended up happening is I had people say, hey, I love this program. And they said, listen, with this program, you qualify for $500,000. Without this program, you qualify for $600,000. And people would say, oh, forget it. I don't need this program. I want to qualify for more. So I think I used the program once. Didn't really work at all. But now they're proposing this for basically conventional mortgages where the maximum amount that you could borrow is 4.5 times your total income. Okay, so there'll be a threshold borrowing amount. The next part they're considering is debt service coverage ratio limits. Okay, so basically when you qualify for a mortgage, any lender that's regulated under OSFI, your total debt or your shelter cost can be up to 39% of your income, and your overall debt, including that shelter cost, can be up to 44% of your income. Many lenders, especially if they're institutional lenders, banks, things like that, could allow ratios to go above and beyond that, depending on the criteria of the particular client. So now what they're saying is, oh, wait a minute, we might put the brakes on this or limit the amount that the lenders can actually do this, and which would definitely lower the amount of people that are qualifying for those higher amounts. The other way this would be affected is a lot of high net worth clients that have a lot of assets and asset-based qualification could potentially be reduced or eliminated as well. So this is another consideration they're doing. Another consideration they're thinking of doing is taking or altering the stress test to increase it for more shorter term or higher risk considered mortgages, which would be short-term mortgages or variable rate mortgages that might mature within a shorter period of time and that more vulnerable or risk to renewing into higher rate terms. Now, here's the problem. This is a public inquiry. They're going to involve a lot of the lenders in this decision. So let's say I'm a bank, okay? And I'm thinking, okay, I make the most amount of money if somebody locks into a 5-year term. Okay, I charge more up front, I make more upfront fees, and on the back end, if they want to get out of that, most of my profits on the mortgages are done with penalties. Banks want you to jump into those 5-year terms. So why wouldn't I say, yeah, let's increase the stress tests for the shorter terms, the variables and everything else. We need our people to get into longer term mortgages because you know what, we're going to benefit from those financially. My concern by those shorter terms variable rate mortgages, by increasing the qualification in terms of how you would qualify for those products and forcing people into a potential product that could cost you so much more, okay, when it comes down to having to break those mortgages, that could be contradictory to exactly what they're actually trying to achieve. So I'm a little bit concerned in terms of who they're asking for their input on this one, because it might not be non-biased, if you know what I mean. These potential changes are coming down the pipeline. Now, what this could potentially do, it could drop a dramatic amount of people out of the marketplace in terms of qualifying. What net effect would that also have on house prices if you took away a good proportion of the home buyers? Where it also starts to create a problem if we have such an influx of new to Canada and over 770,000 people in 2022, another 500,000 coming in 2023. Over 1/3 of new builds have been suspended because of costs, labor, whatever else it is. The supply issue is not being satisfied. So now we're actually going to create a larger gap in terms of being able to qualify to get into homes. I don't know what the solution is, right? Because now it's going to force more people to rent, and it's not like there's a huge amount of rental inventory out there whatsoever. So every time they try to fix one thing, maybe some things don't need to be fixed because it's going to create a whole bunch of additional problems, like a domino effect. The problem is when they do this, it takes almost 6 months to a year to realize the real net effect. All these rate increases that we've seen over the last little while, we haven't really seen the net effect of those yet. It's coming down the pipeline, right? So we'll need to know it. That said, a lot of people have been affected by variable rates, and TD, CIBC have allowed some negative amortizations until the renewal, okay? And this is getting people until the renewal point, and then they have to redo their mortgages. And you're in that particular case too, and you're in a position where you've had your home for a while. You're not necessarily in a position where you're not going to be able to afford your mortgage payments anymore, because maybe it's a matter of just re-amortize it for the interim while we get past this rate hike hump. And then once the rates start to come down again, you can increase those payments and then drop the amortization again. So as long as we have some room in amortization and the amount of years that you have available, you can extend those amortizations to 30 years. Some lenders are doing 35 years, and that actually makes everything more affordable. So if you ever get in a situation where things are payments are getting too high, there's other things that we could do that potentially to help you with the month-to-month payments. So bottom line, to the extent these measures are implemented, further pressure on mortgage growth is likely. As mortgage brokers, we can access lenders that are not impacted by OSFI B20 rule changes. Okay, so more than ever, brokers can help add value for borrowers that are turned away from the banks, or the banks are just being handcuffed because of these regulations, so they cannot help their clients the way they used to. Definitely get some advice from a trained professional. Reach out to a mortgage broker and look at your options. But for home buyers, right, this is a sign that, hey, listen, if these changes are coming down the pipeline, if values have come down, maybe you don't want to wait on the sidelines too much longer. Maybe you need to get into home ownership now. Hopefully this has been helpful. Let me know if you have any questions. Don't forget to subscribe, and look forward to seeing you in the next video.